Hey, it's John from StopSaving.com, and welcome to the next video in our course about trading and technical analysis. This one's about trying to figure out when the price has bottomed, so you can start buying the dip. And when it comes to trying to spot a trend change from a downtrend to an uptrend, it's all about the W's. So, let's jump in. And here's what you'll learn in this video. Number 1, why W bottom patterns are a lot more common than so-called V bottom patterns. 2, the different variations of W patterns, for example, the inverse head and shoulders pattern. And finally, number 3, why it's better to wait for a W pattern to buy the dip than to try catch a falling knife. So let's look at the theory behind W bottom patterns. W patterns are more common than V bottoms, and the reason for this makes sense when you think about it. It's because bottoms usually take a long time to form as traders gain confidence that the first low will hold. So, the price often makes a second low before bottoming out to form a W bottom pattern. And as we'll see in this video, W patterns come in all shapes and sizes. Let's now compare a W bottom pattern with a V bottom using the Bitcoin 1-week chart. So here's the Bitcoin bottom of 2019. The price made its first low with a lot of volatility when brave dip buyers bought the first dip. Things then cooled off a bit after that, and the price made a second low, which took a lot longer to form than the first. Now compare that with Bitcoin's V bottom of 2020. Here, the price never gave the buyers another chance to buy the dip. While these tend to be rare for most assets, compared to W bottoms, they typically happen with a lot of volume traded. And that's what we see here in the shaded circle. Let's get back to W patterns, this time putting the knowledge you gained from our earlier video on trading timeframes to good use. Here's the 1-week chart of gold, and a W pattern that eventually led to a shift in strength from sellers to buyers. The pattern took a few months to form in this case. Let's now zoom into the gold 1-day chart over the same months. Now, we can still see the bigger W pattern from the first chart on the weekly chart. But within the second W, we can also see a W pattern formed on the daily chart too. Of course, this can go on and on as you move into lower and lower time frames. So in this case, by looking at the daily chart, you can get an earlier indication of what's more likely to happen on the weekly chart. Now, not all W patterns are so easy to spot, and they can often be quite complex, like this one here for the VanEck Gold Miners ETF, and that's ticker GDX on the 1-week chart. Here's the bigger W pattern, and then a smaller W within the first W, and then a series of complicated W patterns or W type patterns within the second W. That's a lot of W's. So let's now look at the famous inverse head and shoulders pattern, and we'll use the Bitcoin 1-day chart this time. The first thing to notice is that we have a series of W bottoms. This shows that control is shifting from the sellers to the buyers. Here's the neckline. This is the price area that sellers are trying to defend aggressively. First you have the left shoulder, then the head where the price makes a lower low than it did in the left shoulder, and finally you have the right shoulder. With this shoulder, the sellers can't force the price to make a new low, meaning they're starting to lose control. Finally, the price breaks the neckline and closes above it, and that's the final confirmation that sellers have lost their control. Also notice here how the price retests the neckline a few days later. That would have been a safer trade since price tends to bounce at support more often than not, and you could have set your stop loss closer to your entry price. So that's the end of this quick introduction to W patterns. We'll go a lot more in depth on these later in our indicator section when we learn how to use Bollinger Bands in trading. With that said, here are the key takeaways from this video. Number 1. Most downtrends end with some type of W pattern or series of W patterns. 2. You often see smaller W patterns on lower time frames within bigger W patterns on higher time frames. 3. Bottoms usually take time to form, so don't try to catch a falling knife. Patience is often rewarded. And 4. Inverse head and shoulder patterns are made up of W patterns. And finally, number 5, don't worry too much about how to trade W bottoms for now. Again, we'll cover that in a later video on Bollinger Bands. So that's the end of this video. In the next one, we'll look at the evil cousin of W bottom reversal patterns, and that's M topping patterns. So thanks for watching, and I'll see you in the next video.